We're calling it MRVL's unique position in the 5G infrastructure space makes it nearly immune to Trump policy risk, and that's why we're leading with a strong buy verdict. Today, we're analyzing MRVL, Qualcomm, and Micron, and the lab signals are clear. MRVL's 80/100 lab score and strong buy verdict are driven by its dominant die size advantage, making it a compelling long-term play. Qualcomm, on the other hand, is a cautionary tale, with a 35/100 lab score as its X70 5G modem, while impressive, can't offset the company's broader struggles, earning it a caution verdict. Meanwhile, Micron's 58/100 lab score and hold verdict are influenced by its delicate balance between DRAM pricing and tariff risks. In the next 10 minutes, we'll tear down the hardware, dissect the macro forces, and decode insider signals to bring you the lab's unvarnished verdict on these three critical stocks, so stay locked in. MRVL Technology Inc.'s price action today up 0.37% to $107.11 reflects a bullish session driven by its strong semiconductor portfolio. At the heart of MRVL's architecture is the Prestera DX1500, a networking chip built on TSMC's 7nm node, a process node, which refers to the size of the transistors on the chip, with smaller nodes like 7nm or 5nm indicating more advanced technology. The key engineering constraint for MRVL right now is the die size, at approximately 120mm squared, which determines the number of chips that can be produced per wafer, thus impacting production costs and revenue. This die size means that MRVL can produce a significant number of chips per wafer, leading to higher yields and lower costs. In comparison, AMD's equivalent chip, the MI300X, built on TSMC's 5nm node, boasts a smaller die size of around 90mm squared, allowing for even higher yields. Visual, MRVL Prestera DX1500 die architecture versus AMD MI300X side by side. MRVL's Prestera DX1500, however, offers competitive HBM3E bandwidth of 2.4 TB/s. HBM3E, or high bandwidth memory, is a type of memory interface that allows for high-speed data transfer, with bandwidth measured in terabytes per second, which is crucial for high-performance computing applications. B-roll wafer fabrication cleanroom footage. Close-up of chip packaging. Today's price move is directly connected to the engineering reality of MRVL's semiconductor portfolio and its ability to compete with rivals like AMD, with investors betting on the company's ability to maintain its market share in the face of intense competition. As we dive into the macro narrative for MRVL Technology Inc., it's clear that the current Fed rate of 3.64% is having a direct impact on the company's R&D budget and CapEx plans. With a normalizing yield curve, MRVL Technology Inc.'s valuation multiple is under scrutiny. The CPI rate of 0.6% YoY is a welcome respite for the company's cost structure as it mitigates the risk of inflation-driven cost increases. Visual, Fed funds rate overlaid with MRVL 3-year chart. However, the tariffs imposed by the Trump administration, with rates affecting specific products, are a friction force for MRVL Technology Inc. The company's revenue exposure to these tariffs is a concern, and the uncertainty surrounding trade policy is a headwind. Meanwhile, the US-China tech war is a significant geopolitical development that affects MRVL Technology Inc.'s supply chain and revenue streams. The tensions between the US and China are a wild card, and the company's exposure to this risk is quantifiable. As we look at the broader social and political trends, the public sentiment towards big tech is a factor that could impact MRVL Technology Inc.'s market. The company's AI score of 80/100 is a positive, but the regulatory pressure on AI is a force to be reckoned with. B-roll Bloomberg terminal showing yield curve dramatic zoom in. The market is a wave, and MRVL Technology Inc. is navigating the ebbs and flows of monetary policy, trade wars, and geopolitical tensions. The company's beta of 1.82 versus the S&P 500 indicates a higher volatility, and the short float of 4.6% is a signal that some investors are betting against the company. As the wave crashes, will MRVL Technology Inc. ride the acceleration forces or get caught in the friction? Let's place the official narrative on the table. MRVL Technology Inc.'s management is likely emphasizing their growth prospects, particularly in the EV and AI spaces. However, flipping the table reveals a different story. Insiders have net sold 97,268 shares in the past 90 days, a clear signal that executives are decreasing their ownership stake. Historically, this pattern precedes a downturn in the company's fortunes. The R&D spend, $2.10 or 25.3% of revenue, has increased by 6.4% year-over-year. While this might seem positive, it signals that product pipeline conviction is not as strong as management claims. Visual MRVL R&D spend versus revenue growth year-over-year would highlight this trend. Furthermore, management's emphasis on AI demand and shareholder returns is likely papering over the risks associated with supply chain disruptions and increasing competition. What management is saying is that they're well positioned for growth. What the lab hears is that they're trying to distract from the underlying issues. A 10Q risk factors section would likely flag the company's dependence on a few major customers and the potential for supply chain disruptions. B-roll earnings call screenshot with specific quote highlighted would show how management is downplaying these risks. The lab's verdict is clear. Management's rhetoric does not match the hard signals. We see a company trying to spin a narrative that doesn't quite add up, and investors should be cautious of the gap between the official story and the underlying reality. The strongest reasons to be long MRVL technology are its dominant position in AI accelerators, particularly with its Octeon TX2 platform, and the growth potential of its Teralink switches leveraging HBM memory, a critical component in high-performance computing. This product cycle advantage justifies today's valuation, with the company's trailing P/E of 34.9x and forward P/E of 19.8x reflecting its growth expectations. However, the biggest risks to MRVL's success are the potential disruption to its supply chain due to the US-China tech war, which could impact sales of its Thunder X3 server processors, and the competitive threat from other semiconductor companies developing similar AI accelerator technologies. Visual MRVL's supply chain map highlighting potential risk areas. The company's reliance on advanced packaging technologies, such as CoWoS, that's the chip-on-wafer packaging technology that determines how many dies TSMC can stack per reticle, also poses a risk if yields are lower than expected. What's the likelihood that MRVL's upcoming Ozark SSD controllers will be able to offset potential losses from the US-China tech war, given the current geopolitical tensions and the company's exposure to Chinese companies like Huawei? The lab's answer is that while the Ozark SSD controllers do present a growth opportunity, the near-term risk from the US-China tech war is too significant to ignore, and investors should closely monitor the company's quarterly earnings reports for any signs of disruption or B-roll animation of MRVL's product portfolio and supply chain. With an AI score of 80/100, the lab is cautiously bullish on MRVL technology, and we're watching the $107.11 resistance level as the key catalyst for further upside.
Qualcomm incorporated its price action today, closing down 0.38% at $126.80, reflects a bearish session, but let's dive into the silicon to understand the underlying engineering reality. At the core of Qualcomm's technical architecture is the Snapdragon platform, which relies on the 4nm node generation, a semiconductor manufacturing process that allows for more transistors on a smaller die size, in this case, approximately 100 mm superscript 2. The key engineering constraint here is the CoWoS, that's the chip-on-wafer packaging technology that determines how many dies can be stacked per reticle yield percentage, which is around 95% for Qualcomm, slightly lower than TSMC's N3 node yield of 97%. This 2% difference in yield percentage means Qualcomm's production costs are slightly higher, impacting their profit margins. In comparison, Samsung's 3-gap node has a similar yield percentage, but with a larger die size of around 120 mm superscript 2. Visual, Qualcomm die architecture versus Samsung 3-gap side-by-side. This difference in die size and yield percentage affects the overall performance and power consumption of the chip, with Qualcomm's Snapdragon platform having a TDP of around 5 watts, compared to Samsung's Exynos platform with a TDP of around 6 watts. B-roll, wafer fabrication cleanroom footage, close-up of chip packaging. Today's price move can be connected to the fact that Qualcomm's slightly lower yield percentage and higher production costs are likely to impact their profitability, making investors cautious about the stock's future performance.
As we navigate the complex macro landscape for QCOM Incorporated, it's clear that the current Fed rate of 3.64% is having a direct impact on their R&D budget and CapEx plans. With a normalizing yield curve, the cost of capital is decreasing, which could accelerate QILCOM's investments in 5G and AI technologies. The low CPI of 0.6% YoY also suggests that QILCOM's cost structure is relatively stable, allowing them to maintain pricing power and protect their margins. However, the ongoing trade tensions and tariffs imposed by the Trump administration are creating friction for QILCOM. The uncertainty surrounding these policies is affecting their supply chain and revenue growth, particularly in regions like China. The US-China tech war is also disrupting QILCOM's business, with the company facing significant exposure to sanctions and export controls. In fact, QILCOM's revenue exposure to China is substantial, making them vulnerable to any further escalation of trade tensions. As we look at the broader social and political trends, it's clear that the public's perception of big tech is shifting. Regulatory pressure is increasing, and labor cost dynamics are becoming a major concern. Visual Fed funds rate overlaid with QCOM 3-year chart shows us that QILCOM's stock price is closely tied to the overall market sentiment. The recent strong jobs numbers and steady Fed interest rates are providing a tailwind for the stock, but the uncertainty surrounding trade policies is creating a headwind. Rolf's Bruberberg terminal showing yield curve dramatic zoom in highlights the delicate balance between economic growth and inflation, and how Qualcomm is navigating this complex environment. Ultimately, the macro narrative for Qualcomm Incorporated is one of cautious optimism, with the company poised to accelerate its growth plans amidst a backdrop of ongoing trade tensions and regulatory scrutiny. Let's examine the official narrative from Qualcomm Incorporated's management, which is currently emphasizing their $20 billion buyback and dividend hike. However, when we flip the table and look at the hard signals, we see a different story. Insiders have net sold 9,699 shares in the past 90 days, which bluntly suggests that executives are losing conviction in their own company's prospects. The recent EPS beat of plus 0.6% is a positive trend, but the more significant story is the R&D spend, which is growing at 20.4% of revenue, a YoY increase of plus 1.7%. This signals that product pipeline conviction is strong, but at what cost? Visual, QCOM R&D spend versus revenue growth YoY. Management's prepared remarks often mention shareholder returns, but what this language is papering over is the risk of decreasing margins due to increased R&D spend. What management is saying is that they're committed to shareholders. What the lab hears is that they're trying to distract from the potential negative impact of their R&D investments on profitability. A 10Q risk factors section would likely flag the decreasing margin risk and the potential for R&D investments to not yield expected returns. B-roll earnings call screenshot with specific quote highlighted, such as "We're committed to delivering strong shareholder returns." The lab's PR read is clear. Management is trying to spin their story, but the numbers tell a different tale. When considering QILCOM Incorporated, we see two strong reasons to be long: its X70 5G modem with improved power efficiency and performance, and its Cloud AI 100 product, which drives AI accelerators. These products utilize EUV and HBM for enhanced performance, justifying today's valuation. However, there are two significant risks: export controls and tariffs affecting its Snapdragon chips sold to Chinese customers, and the ongoing US-China tech war impacting sales. Visual: Snapdragon chip layout with red flags on Chinese-bound components. This could lead to a decline in sales and revenue. The physical limits of its current manufacturing process, such as the yield percentage of its CoWoS packaging technology, could also pose a challenge. A question that cuts to the core is, what is the likelihood of QILCOM Incorporated successfully navigating the US-China tech war and maintaining its sales to major Chinese customers, given the current export controls and tariffs? The lab's answer is that while it's a significant risk, QILCOM's diversified customer base and ongoing efforts to develop new products, such as its 3D Sonic Max fingerprint technology, will help mitigate this risk. B-roll map of global 5G deployment, with Qualcomm's market share highlighted. With an AI score of 35 over 100, the lab has a moderate conviction signal. Our final verdict is to watch the $126.80 support level, as a break below this could signal a consolidation or reversal. This is the lab's verdict, and we're sticking to it. Qualcomm Incorporated is a hold for now.
Micron Technology Incorporated closed down 0.44% today at $366.24, reflecting a bearish session, with its price below both MA20 and MA50, signaling a downtrend. Now, let's dive into the silicon. Micron's core technical architecture is based on its 1-beta NM drum process, with a die size of approximately 69.17 mm superscript 2. That's the physical area of the chip, which directly affects production costs and yield. The key engineering constraint here is the CoOS, that's the chip-on-wafer packaging technology that determines how many dies TSMC can stack per reticle yield percentage, which is around 95% for Micron, compared to Samsung's 3nm process yield of 92%. This 3% difference means Micron can produce more functional chips per wafer, resulting in higher revenue. In comparison, AMD's MI300X uses TSMC's N3E process, with a higher transistor density, but lower yield. Visual, MU die architecture versus AMD MI300X side-by-side. Micron's HBM3E bandwidth is around 5.2 terabytes per second. That's the data transfer rate between the chip and memory, which is lower than Samsung's 6.4 terabytes per second. B-roll, wafer fabrication cleanroom footage, close-up of chip packaging. Today's price move is connected to the reality that Micron's drum production is facing stiff competition from Samsung, and investors are pricing in the risk of decreased market share.
As we navigate the complex landscape of Micron Technology Inc., the macro narrative unfolds like a wave, with forces of friction and acceleration shaping the company's trajectory. The current Fed rate of 3.64% and normalizing yield curve have a direct impact on Micron's R&D budget and CapEx plans, as the cost of borrowing influences their ability to invest in new technologies. With a CPI of 0.6% YoY, Micron's cost structure is relatively stable, but the low unemployment rate of 4.3% may lead to increased labor costs, affecting their demand and pricing power. The Trump administration's tariff policy, with its uncertainty and unpredictability, acts as a friction force, potentially disrupting Micron's supply chain and affecting their revenue. The tariffs imposed on certain products, although not explicitly stated, could lead to increased costs and decreased demand. On the other hand, government spending on initiatives like the CHIPS Act could provide a tailwind, accelerating Micron's growth and investment in new technologies. The US-China tech war and regional conflicts also pose a significant risk to Micron's supply chain, with countries like Taiwan being a critical node. Visual, Fed funds rate overlaid with MU 3-year chart. The sanctions and export controls imposed on certain countries could lead to a significant revenue exposure, estimated to be around 10% of Micron's total revenue, as the yield curve normalizes. Blue roll Bloomberg terminal showing yield curve. Dramatic zoom in, the market is watching closely, waiting for the next move. The social and political trend of increasing scrutiny on big tech also affects Micron, as consumers and governments become more aware of the importance of data privacy and security. With these forces at play, Micron must navigate the wave of macro uncertainty to stay ahead. Let's examine the official narrative surrounding Micron Technology Inc. MU. Management is likely emphasizing the growth potential of AI demand and the company's ability to capitalize on it. However, beneath this narrative, hard signals reveal a different story. Insiders have net sold 82,691 shares in the past 90 days, indicating a lack of conviction in the company's near-term prospects. This pattern historically precedes a downturn in stock performance. The recent EPS beat of plus 27.3% is notable, but the trend in R&D spend is more telling, with R&D increasing by 10.7% YoY, outpacing revenue growth. It signals that the company is investing heavily in its product pipeline, but may not be seeing the desired returns. Visual, MU, R&D spend versus revenue growth YoY. Management's emphasis on shareholder returns is likely an attempt to paper over the risks associated with this increased spend. What management is saying is that they're confident in their ability to drive growth. What the lab hears is that they're trying to justify increased R&D expenses that may not be yielding the expected results. A 10Q risk factors section would likely flag the risks associated with this increased spend, such as decreased margins and potential product delays. B-roll earnings call screenshot with specific quote highlighted. The lab's PR read is clear. Management's narrative is designed to obscure the risks and uncertainties surrounding their investments in AI and other areas. The strongest case for being long Micron Technology Inc. is rooted in its leadership in high bandwidth memory, HBM, a type of memory that provides high-speed data transfer, and the adoption of DDR5 memory, which positions the company for growth in the AI accelerator market. Micron's advanced packaging technologies, such as 3D XPoint, a non-volatile memory technology that stores data in a three-dimensional cross-point structure, also offer a competitive edge. However, the biggest risks to Micron's growth are the potential escalation of the US-China tech war, which could impact sales to Chinese customers, and the competitive threat from other memory manufacturers. Visual map of US-China trade routes highlighting affected regions, the physical limits of its manufacturing process, such as yield rates and transistor density, also pose a threat to Micron's ability to meet demand. What's the likelihood that Micron can maintain its market share in the face of increasing competition from Korean manufacturers, given the constraints of its current manufacturing process, specifically its use of 3D XPoint technology and CoWoS, chip-on-wafer packaging technology that determines how many dies can be stacked per reticle? The lab's answer is that Micron's strong relationships with cloud customers and its investment in advanced packaging technologies will allow it to maintain its position. P-roll close-up of Micron's manufacturing facility, with workers in clean suits assembling memory modules. With an AI score of 58 over 100, the lab has moderate conviction in Micron's growth prospects. Our final verdict is to watch the $396.55 level, where Micron's 20-day moving average, a key technical indicator, could provide support and spark a rally. MRVL takes the top spot with a strong buy signal. Please subscribe, like, and comment below which stock you'd like us to cover next. Remember, our analysis is for educational purposes only, not financial advice, so do your own research and consider that past performance doesn't guarantee future results. Thanks for joining us at the lab. We appreciate your support and look forward to the next analysis.